Well, welcome everyone. I'm Derek Mazzarella here with Gateway Financial Partners. I'm a certified financial planner, and I am thrilled to be here with Tracy Williams today of Norcom Mortgage. Tracy, how are you?
I'm doing well. It's cold out there. I'm staying warm.
It is, yeah, I know. It's the Northeast though, so you get what you pay for.
All right.
So I'm so excited to have Tracy here today. She's going to kind of talk a little bit about reverse mortgages, but first a quick little bio on Tracy. I know she started out in the banking industry, worked for some startups, worked her way through. She was a coach and throughout her life, and she's making sure she makes people better and teaches them how to be better athletes and also better with their money. So today we're going to focus really on reverse mortgages. I know there's a lot of, I don't know about these and how do they work? It's like this kind of mystery box, and maybe it's only for a couple of people. So even, as a financial advisor, before I learned about them, I kind of had a negative connotation of them. So I love to just kind of start off with Tracy. What are some of the big myths surrounding reverse mortgages?
Yeah, sure. So that is actually a common thing that we hear are all the misconceptions that, the bank's going to own my home. The loans are too complicated. They're too expensive. It should only be used as the last resort. And I have learned a lot that the last resort issue, I have learned a lot about recently, and I think we'll probably get into that a little more in one of your other questions. But first off, to address the bank owning your home, the bank never owns your home. You own your home. You're free to do what you want with it. If you want to re-side it pink and paint the front door purple, that's totally your call. You can do that. And you'll never owe more than the house is worth. So one of the things that comes up about the cost is there's an insurance that goes with it. It's a federally insured loan, and it's that insurance that makes sure that you never owe more than your house is worth. So when it comes to the end, when the loan is due, if your house doesn't cover the amount that's owed, the insurance pays the difference. Your heirs never have to pay that debt. The insurance covers it. But that's why it's expensive, is because you're pre-funding that 30 years of insurance up front.
So can I just clarify that? So if, let's say I have a $500,000 house and I take out a reverse mortgage, and then all of a sudden I take out, 600,000, is that even possible? And if it is, then you're saying the insurance covers it.
Yeah, sure. The loan balance could grow to more than the house is worth for a variety of reasons. The real estate market might bottom out and your house just devalues rather than increases in value, and the loan amount keeps growing. So it is very possible. But that's where the insurance comes into play, is the insurance would cover if your house is worth 400,000 and you owe 600, the house will pay the first 400 and the insurance pays the difference.
Gotcha. Okay. So then you essentially in that scenario, you're walking away, you don't know anything.
Right.
Okay.
But the flip side of that too is it's a loan like any other loan, like Tom Selleck says on TV, and there's no prepayment penalty. You can pay it off at any time. So say you take out a reverse mortgage because you think, oh, I'm going to be short cash flow during my retirement. I'm going to use my house equity and take out a reverse mortgage. Then you win the lottery and you're like, oh, I don't need this loan anymore. It's, you can pay it off, right, just like any other loan.
So we're planning for the most likely scenario. That's what you're telling me here. Winning the lottery, pay off.
Exactly. Right. But there is no requirement to pay. And that's what the feature is in the reverse mortgage that makes it attractive to retirees, is you're not required to make any payments on the loan.
Gotcha.
Until you permanently leave the home. And there's 3 ways you can permanently leave the home. You move out, move in with your kids or something like that. You sell the house, or unfortunately you pass away.
Right. Okay. So they're never going to say, hey, this is mine. I'm taking this house because we own it. Okay.
Correct.
Are there any other myths out there or misconceptions with reverse mortgages?
There's one, I made a note here to make sure I mention that it's loan proceeds, not income. So it's not taxable as income. And for that reason, it should not interfere with other types of assistance plans. You would want to check with your caseworker, whomever, just to verify that. But as it's not a taxable source of income.
Oh, okay. So just to clear up what Tracy's talking about, there are certain programs that people can get on with this, whether it's assistance or even things like, hey, I've Medicare, and your payments for Medicare are based on your income. So if you get a reverse mortgage and you're taking money from it, that's not countable as income. So it's not going to raise your Medicare rates based
Right.
on the money you're taking out. So
Right.
that's great. Okay. Perfect. So can you just kind of walk us through a little bit of how a reverse mortgage actually works from like a mechanical standpoint?
Yeah, sure. So you're qualified for the loan based on your age, the value of your home, your income, and your credit. So one of the borrowers, if you're a married couple, one borrower has to be at least 62 years old.
Mhm.
Your credit has to be, decent. You're not allowed to have more than, I think, one late payment on a mortgage. The income has to be sufficient to pay the property expenses, and that includes property taxes, homeowners insurance, any homeowners association fees, and then we account for a property maintenance expense at like a certain number of cents per dollar.
Okay.
And then there has to be a residual income left over. So there's a calculation we go through where we take away all those property expenses to see what you have left, and you have to meet a target residual income. And then the borrowers have to complete a loan counseling program so that they understand how it works. And that's, I think, done by phone. And like I mentioned before, the loans are insured by the federal government. All of the closing costs and insurance payments are made from the first disbursement of the loan. There are two loan options. One is a fixed rate loan with a lump sum disbursement at the closing. The other way you can set up the reverse is an adjustable rate loan that you can access in three ways: the lump sum, monthly payments like a disbursement regularly, or a line of credit, or any combination of the three. And the nice feature about that line of credit is any unused portion grows. They say compounds at the rate of interest, which is basically like having your credit limit raised every year. So if you leave a large portion unused, that credit limit that increases every year, you could use to pay the property taxes or maintenance or whatever. And in that way, it's a constantly replenishing source of funds, and the house is paying for itself.
Right. So in that scenario, because sometimes I've advised clients that, hey, this is maybe something you want to look at earlier rather than later, because let's say you have your expenses covered for the first 10, 15 years of retirement, but you want to make sure the back end is covered. You can actually start this process today and then have that essentially that pool of money build up over time. So it's not like something you should wait till, you're at the end where like, oh, I only have 10,000 left. I guess I need to do this now. It should be something
Right.
that, is built into your plan for the long haul.
Right. Right. Yes. And the earlier you set it up and don't use it, the more it's going to grow.
Gotcha. Okay. That's great.
And then, as I mentioned earlier, when you leave the home permanently in one of three ways, that's when the loan becomes due. And if unfortunately you've left the home permanently because you have expired, your heirs have 6 months to sell the house or refinance it. And I think that 6 months is extendable by another 6, just in case. But yeah, so it's, your heirs aren't stuck doing something different than anybody else's heirs would be doing with a house.
So, I mean, at the end of the day, it's a pretty flexible option, because you can either take it now, take a large chunk, you can take a little bit over time, or you can start it now, but wait
Exactly.
till later on.
Exactly.
Right. Okay. Right. One more question, because, I know you kind of mentioned the last resort thing. And I found, especially with planning with clients, a big goal of clients is to have their mortgage paid off so they don't have that mortgage payment in retirement. So how can, an average person or even a wealthy person leverage reverse mortgages in their retirement for their own benefit?
Sure. So as you know, the house is the largest, probably one of the larger non-performing assets in a person's portfolio. And a reverse, I read this really cool book. I think I told you about this a while ago. I think I was reading it when you and I met. It's called Housing Wealth: An Advisor's Guide to Reverse Mortgages. And it was written by a guy who was a family planner. And his name is Don Graves. And he went through just a really technical analysis about all the scenarios where a reverse mortgage would be helpful. to use the reverse in combination with other retirement strategies to enhance outcomes. That was how he mentioned enhance outcomes a lot in his book. But he also says, the housing wealth it's worthless unless you access it. So you can use it to manage your income and your tax bracket, because again, especially early in retirement, when you're likelier in a higher tax bracket, you can use this source of income, which is tax-free, and defer Social Security or annuities or some other taxable source of income to later when your benefits may be higher because you've deferred them to an older age. And you can use it as an insurance policy against the risk of loss due to market volatility, inflation, sequence of returns, and longevity risks. So the people who access reverse mortgages kind of fall into 4 categories. The first 2 are, people who are more on that last resort category, the ones who are focused on survival. They didn't save enough for retirement and they need this to be able to make their expenses. The other people are people who need to be rescued from unexpected events, an expensive illness or the premature loss of a job, those kinds of people who need to kind of bridge that gap. Then you have the people like you were asking about, the people who are more comfortable, those who are focused on a contingency. They have a workable plan, but they're a little worried. They're not sure they can weather an unexpected event. And then you have people who they have a great plan, but they may want to improve it. They're comfortable enough, but they want to enhance to allow increased spending, hedge for market corrections, allow for legacy gifting, those kinds of options. And a lot of people don't realize also that you can use a reverse mortgage to purchase. So the example, we have a reverse mortgage expert at Norcom. His name is John Luddy, and he always gives the example of right sizing rather than downsizing. So you sell your $400,000 house and move into the retirement community, but the wife wants all the bells and whistles, and turns out your right sizing house is not cheaper than the house you're selling, and you don't want a mortgage.
Right.
So you take the equity from the house you're selling, put it toward the new house, and take out a reverse for any difference, and you can buy a new place without having a mortgage payment.
Right. Oh, that's great. Yeah. I mean, I found that to happen quite often. Make it the smaller place, but the smaller place is often much nicer.
More expensive. Exactly.
Yeah. So definitely see that pretty often. So Tracy, that was great. I think you kind of busted a bunch of myths about reverse mortgages and how you can use them. Obviously these are somewhat complicated, so definitely reach out to someone like Tracy to get an understanding of how they work. Talk with your financial advisor about how they would fit in with your retirement. And as always, when it comes to taxation of items, definitely consult your CPA. So Tracy, how can people find more out about you?
You can call me. My number is 860-490-4234. I have a website. It's tracywilliams.norcommortgage.com. There, on that website, you can click around and find out all different kinds of information about different loan programs. You can even schedule an appointment with me, or reach me by email, tracy.williams@norcom-usa.com.
Okay, great. Well, Tracy, thank you so much. This is an excellent resource. I think you've probably proven that reverse mortgages aren't as scary, or they're not the boogeyman they claim to be on the internet. So thank you so much, and looking forward to talking with you again.
Thank you for having me. This was great. Thanks.
Great.
Losing time, I'm fading fast. I just wanna make it last. Try to let go